Welcome back, folks. This is lesson 2.2 of the January 2017 ICT mentorship. We're going to be looking at qualifying trade conditions with the 10-year yields. Okay, in the previous teaching, 2.1, we had looked at the 10-year note seasonal tendency, where it has a strong tendency to rally in June. And we're looking at the 10-year note for September 2015 here. You can see how during the month of June of 2015, 10-year note did in fact make a low in June. And while the seasonal tendency is in force, how do you know the seasonal tendency is most likely going to occur? Well, the first step is you want to start looking to qualify the swings in relationship to the dollar index. And that's seen by looking at these lower lows here. So our delineation begins at the beginning of June 2015, and the subsequent lower lows that transpired after June 2015 began. We started seeing a slide in price. It took out the low from May, but individually there was 5 to 6 different candles that progressively kept making lower lows in the first half of June. That's being delineated here with this short little trend line. Now, in the dollar index, this is going to be ideally seen with a series of higher highs. That's how market symmetry should be posted and delivered in price. But let's take a look at what actually happens in the dollar index. At that same moment, we can see that the dollar index for June 2015, immediately to the right or after June 1st trading day, we were making lower highs. So this is a crack in correlation, and we have confirmation now there is a trade idea unfolding in the 10-year Treasury note against the dollar index. It's further confirmed by seeing the interest rate market declining at that time. As the yield declines, the futures price on the 10-year note was actually rallying. Note also that the consolidation that the yield stayed in, which also led to a consolidation in dollar index, 10-year Treasury, and foreign currencies at the same time in 2015. Okay, we're looking at the June of 2016. Again, we're looking at that seasonal tendency seen here. The market was making equal lows, so they should be seen in respect to the dollar index with equal highs. Here's the dollar index going into June of 2016. As you see here, the market made higher highs. This is a crack in correlation. The market's shown a willingness to go higher in the dollar index, but it was not seen in the form of going lower on the 10-year notes. That's a crack in correlation there. Therefore, it is a qualifying condition that there is an underlying trade underway. And this is further confirmed by visually seeing the interest rate market, seeing a decline in the 10-year yields. And again, notice the consolidation. While it looks like if you zoomed in really tight, it would look like an uptrend, but we're still in a rather large consolidation. And that is attributing factors to why the currency markets had a consolidation this period of time. Lastly, we have the 10-year Treasury note March contract 2017. We have a lower high. Now, I know you're looking at that big wick on the elections, but dispel that for a moment. Focus on the market structure alone without that wick. We have lower high formed in the first couple days of November relative to the mid-October highs. So that should be seen supported in the dollar index as well, just contrary. In fact, we see a lower low. So for the dollar index to have a lower low here, we should have seen a higher high form in the 10-year note. That didn't happen. We see the opposite with a lower low in dollar index. We don't see the higher high in 10-year Treasury notes as you would expect to see with the lower low in dollar index. Again, it's going to be a mirror image of everything you see for perfect symmetry. When that symmetry is broken, it indicates that there is a underlying trend or manipulation underway. You can also see the open interest decline in November, supporting the idea that there was short covering by the smart money, and the dollar index moved up as a result. Again, because the 10-year note was in a move that was trending and had more range to go lower, that supports the trending move on the dollar index, where I was allowed to trade for 2 complete months. And you can see it's supported with the increase in the interest rate yield on the 10-year note during that time when the dollar rallied. Markets seek yield, and if the interest rate's increasing, therefore the dollar has a strong tendency to want to rally as well. Now, as a side note, when we see these things occurring in the price, you want to be blending these ideas with the quarterly shift concepts that's been taught in this month's content. So if we're looking for the next 3 to 4 months potential next swing, not that we're holding for that period of time, or our time horizon is 3 months out. Generally, it's going to be half that time frame for the trade setups to come to fruition and complete. Sometimes the trades will last longer and go a full duration of 3 months, and sometimes a little bit longer. But as I mentioned in this mentorship, my time horizon is about 3 months. I think it's pretty much as realistic as you're going to get, because long-term trends, while they all generally stay in a long-term trending environment, they can reverse, and if it's in a long-term uptrend, you don't want to be trying to pick the top. So it's important that I remind you every time we talk about this that my focus primarily is looking at a time horizon of 3 months, with the expectation I'm going to trade with a position that may go up to 3 months, but rarely, admittedly, I don't hold that long. It's usually half that time frame. But you can go in and look at these times when the seasonals align, and there are qualifying SMT divergences between the dollar index and the 10-year note. When they have that pattern there, you can also qualify it with an intratrade triad. Or you can go into a Forex currency pair and look for a SMT divergence against the dollar index that way. Those ideas blended together, not that you need both of them, but one of them will give you a qualification for a trade idea that may be unfolding for a quarterly shift. By getting in sync with the marketplace like this and viewing the higher time frame charts with these tools in alignment, it gives your trades high probability, and it filters out a lot of the noise. And even if you don't trade in a long-term position capacity, you can use these ideas to get in sync with higher time frame trend or higher time frame order flow. And by doing that, it puts all of your swing trade, short-term trade, day trade, and scalps in line with institutional order flow. And with that, it's very hard to go wrong. Not perfect. It doesn't negate the opportunity for you to lose money, but it certainly does put the odds in your favor. Until next time, wish you good luck and good trading.